A bearish sign today for the job market. The Labor Department revising U.S. payrolls down by 818,000. CNBC's Rick Santelli has more on that, Rick.
Yes, Leslie. It wasn't a shock, and it was within the range of what we expected. 350,000 up to 1 million. And as you look at the charts, I put a 2-year going all the way back to May of 23 because we were toying with potentially closing under 388 briefly, but we didn't do it. We avoided the worst case. Same could be said for 10s, which closed almost virtually unchanged after a very volatile session. So we didn't comp it back to July of last year, but we're very close. The dollar index stuck, that weakness stuck. We did close at the lowest levels of the year, 818,000. I guess what concerns me most is how little attention was paid to it with respect to the experts. They said it really doesn't mean anything. It's old. It's from April of 23 to March of 24. All I know is that a few bricks of that Fed foundation with regard to what their policy is built on was predicated on a strong labor market. Now we find it's not nearly as strong as we thought it was.
Coming up today, a huge downward revision in the jobs market. Is it all just smoke and mirrors? The US dollar hits a yearly low, the warning signal not seen in a century, the latest retail earnings, and all the action in the commodities market. You're going to like this one, guys. And so you got to admit the stock market is pretty resilient in the face of that huge downward revision in the US jobs market for the year ending March 2024. Apparently the Bureau of Labor Statistics got it wrong by 818,000. Quite the miss, and pretty convenient in an election year too, if you ask me. Did get a bit of a reaction out of currency and bond markets, which I'll show you a bit later on. However, just looking at the S&P 500 here, remarkably finished the day higher. Still looking really green across market color. Pretty much perfect. Bond yields, oil, energy, the dollar and inflation expectations, all red across the board. However, technically, we could be setting up a bit of a bearish divergence, double top here. You can see that on my main technical chart as well. Just fired off the second consecutive reversal signal, and this resistance zone has definitely been tested. Wouldn't be surprised if we smash up to new all-time highs, especially after we hear from Jay Powell. I'd say it's pretty much guaranteed he's going to start cutting rates next month after the jobs market's been completely goosed, and that's pretty much half of his dual mandate. Two big areas of the economy they really focus on, jobs and inflation. Jobs market apparently not as strong as we've all been led to believe, but that didn't appear to upset the stock market at all. Russell 2000 back to holding above its 50-day, up 1.3% today. Volume breadth pretty good, along with market breadth, still pretty firm here as well. Did get a little bit of a bump up in volatility markets, but stick with me because we'll come back to the charts in a bit and I'll show you what else is moving out there today. First, let's just talk a bit about the main headline across financial media today, and that's the big downward revision in the jobs market. US economy added 818,000 fewer jobs than initially reported from April 2023 through March 2024, which equates to about 30% less jobs created in the US economy than what we initially thought. Still saw net job growth in that time. However, which way you cut it, jobs market is weaker than reported, and it's kind of insulting to all of us in financial media who have to rely on these data prints to work out our analysis and opinions on markets. It just really undermines the reputation of the Bureau of Labor Statistics, the government in general, and you would think in today's day and age, with all the cloud, data analytics, AI, all this stuff should be reported accurately, pretty much in real time, if not weekly or monthly, and sure, they'll always have to clean up their numbers at a later date. However, missing by 30%, kind of a bit of a joke, isn't it? Really just makes you question a lot of their reporting, but as always, that's why we key off price action and technical analysis first and foremost. Looks like the bond market saw this coming, has been trading really weak, big gap between the Fed funds rate and the 2-year, and there's a look at the revision broken up into different categories. With professional and business services, leisure and hospitality, trade, transportation, and utilities and manufacturing having the biggest downward revisions. And just to put it into context, their downward revision, easily the biggest in the last decade, and in fact it was just behind the all-time record back in 2009, in which the government did a downward revision to the jobs market, 824,000, just 6,000 more jobs than this time. However, that was in the midst of the global financial crisis, a literal 1-in-100-year financial storm that threw plenty of numbers out of whack. What was their excuse this year? However, not all as it seems. Just looking at a research note here from Goldman Sachs, they think today's downward revision to payroll growth exaggerates the degree to which job growth has been overstated by about 500,000, both because the QCEW, that's the quarterly census of employment and wages, likely excludes many unauthorized immigrants who are not in the unemployment insurance system. That's what they use to get better numbers when they do their revisions, instead of the initial surveys. But were correctly picked up in the payrolls initially, and because the QCEW itself has tended to be revised up in recent years. As a result, we think the true downward revision should be about 300,000 or 25,000 per month, which would imply that monthly job growth over this period was closer to 215,000 to 220,000 than the initially reported 242,000, but not as low as the 174,000 pace implied by the revisions today. Again, that's not hard to believe at all. The United States has had a record amount of illegal immigrants over the last 4 years. Absolutely exploded like never before in history. And of course, most of them are working illegally. They don't have insurance. They're not showing up in the insurance system where they finalize their numbers. However, they do show up in the payrolls, surveys. They go into the initial headline reports. So I guess when you got millions of illegal immigrants entering your border, it does muddy things quite a bit. And it's further muddied when the current sitting Secretary of Commerce, Gina Raimondo, was questioned today that nearly 1 million jobs that have apparently been created do not exist. She said she doesn't believe it, and the reporter said it's from the Bureau of Labor, to which she responded, "I'm not familiar with that." So like I said, the whole thing just undermines the government's reputation and credibility for accurate reporting. They should just outsource the whole thing to the private sector, who will do a way better job at giving accurate data analytics on the jobs market. However, let's not get our hopes up on that happening anytime soon. Just looking at the reactions in financial markets, we did see treasury yields trade pretty heavy today, given a lift to bond ETFs. And just looking at the 2-year yield here, like I've been saying, it already been trading pretty heavy this last 2 months, like it already knew this was coming. Still down a little lower today, however it could be finding a bottom here, as I can see a bit of a divergence on my DSI, as we're starting to form a bit of a double bottom, and it could be a bit of the sell the rumor, buy the news here. Getting a similar pattern on the 10-year as well, bit of a bullish divergence on a potential double bottom. However, we really do need these levels to be defended pretty soon if we get down to 375, because if we break down here, make a new low, that's really not a good sign for economic growth around the corner. But like I've been saying since 2 Mondays ago, I'm still cautiously optimistic on risk markets and the economy. High yield bonds actually traded up today. Just like the stock market, couldn't care less about this massive revision in the jobs market. Like I said, they may be keying more off what Goldman Sachs said. All the illegals working out there weren't accounted in this big downward revision. High yield credit spreads as well over treasuries, still really low here. Just going out to a monthly chart on this. Not worried at all, not pricing in anything bad happening anytime soon. Market's more than happy to lend to risky companies, only asking 3.2 percentage points of premium over treasuries in return. However, one market did take note of this downward revision, which is likely implying a much more dovish Fed, and that's the very important US dollar, which just like the 2-year as well, has been trading pretty weak this last couple of months. I think it's seen it coming. But again, it could be a sell the rumor, buy the news event. We are looking a little technically stretched here in the short term. Got a green reversal signal on the chart here. Don't really have a bullish divergence on the DSI though. That's not suggesting a bottom just yet. And it's quite a bit of weakness there in the US dollar. Likely given a bit of support to Bitcoin as well. Just sitting at its 50-day average, $61,000 a coin. And stick with me because I'll come back to gold in a bit and I'll show you what's going on in there, along with the silver market. Got some interesting stats for you guys. But just getting back into the macro for a bit. Just got the latest print from Trueflation, currently tracking at an annualized rate of 1.34%. That's a yearly low. So this on top of a weaker jobs market, in addition to the FOMC minutes we just got today as well, showing the vast majority of Fed members support a cut in September, pretty much saying if inflation comes in as expected. And like I said, the balance of the scales over the last couple of months has tipped from the upside risk of inflation to the downside risk of the economy contracting. And I would be very surprised if Jay Powell came out with any hawkish language this Friday in Jackson Hole. I'd expect him to kind of hint and confirm that he will cut rates next month. Bond markets and the dollar certainly pricing that in, along with Fed fund futures, which surprisingly didn't get that much more dovish today after that downward revision. Still placing a greater than not chance the Fed will cut 25 basis points next month, not 50, which again, I'm sticking to my odds of about 70%. And after today's print, I would lower my odds of them staying on hold to about 10%, and I'd put the odds at a 50 basis point cut about 20%, 1 in 5. I would be very surprised if Jay Powell stayed on hold next month now. And so more and more financial markets are starting to price in some potential economic weakness around the corner. 10-year bond yield trading really heavy. Fed fund futures pointing sharply down for the path of interest rates over the next year. Got crude testing the bottom end of support as well. Already got gold ripping up, which is normally a flight to safety trade. Bond funds look to have put in a bottom, potentially already in an uptrend. But a lot of the stock market's partying like it's 1999, which it very well could turn out to be like if we do see a recession next year. Top of that, we've got a warning signal not seen in a century. According to billionaire investor Mark Mobius, he's cautioning against stocks amid a decline in the money supply, saying investors should be keeping at least a fifth of their portfolio in cash. And what he's talking about is the drawdown and M2 money supply in the economy. And you can kind of think of that as the liquidity in the economy. That's a total of all cash, savings, money market funds, kind of short-term liquidity in the economy, which exploded coming out of COVID thanks to all the government stimulus, pretty much just throwing a lot of money at people, many of whom didn't need it, along with the Fed dropping rates to zero, also flooding markets with fake money as well. Just exploded liquidity in the system. Along with it, just about every asset imaginable. No surprise at all, inflation at 40-year highs, thanks to all of that as well. However, they're trying to tell us now it's your local grocery store's fault for all that inflation. However, according to Mobius, this decline is historically significant because M2 has not seen such a drop in over 90 years. Said investors should look for companies with little or no debt, moderate earnings growth, and a high return on capital, and get ready to re-enter the market with a little bit of dry powder on hand. And it's true, just looking at M2 money supply, it has peaked out in April 2022. It's come off a little bit. I mean, when you look at a 10-year chart and even max chart, yeah, there is a little drawdown, but it's still so much above pre-COVID amount of money and liquidity sloshing out there. And the market just knows if things get bad enough, the Fed and the government will do it all again. Flood the markets and economy with liquidity. Why? Because they can. US dollar, global currency reserve, allows them to get away with all that for now. But I agree with Mobius. I'm tilting my portfolios more towards defensive companies as well. To account for the recession risk, I'm preferring to invest in companies with little or no debt, good liquidity on their balance sheets, still at least a little bit of growth, but I am very wary of investing in the really high growth, high beta stuff out there. Just technically and fundamentally, looking at valuations here, the relative forward PE of value versus growth, currently almost 2 standard deviations below the average. Only time we went below that was back in the late 90s. That was a great time to dollar cost average into value stocks. Along with small caps, commodities, emerging markets, all significantly outperformed over the following decade until they peaked out in 08 as well. And here's a look at a long-term 2-monthly chart of the spread between the Nasdaq and the Russell 2000. Large tech stocks versus small caps. See that sharp ascent in the late 90s, topped out, dropped to like an absolute rock. It's been melting up since about 2007, starting to fire off some reversal signals on this chart as well, suggesting we could be potentially a bit extended here in the Nasdaq versus the Russell 2000. Again, why I'm leaning more towards small caps for the coming years as well. Not to say I'm completely ignoring tech stocks, I still have some. I'm just preferring to lean more and more towards small caps going forward. And on the other hand, all of that growth and valuations is kind of justified. Nvidia is head and shoulders above the rest. Companies are spending like crazy. Doesn't look like it's going to reverse anytime soon. And we'll get another taste of that next week when we get to hear from them on their Q2 earnings, expected to deliver 64 cents per share in earnings on 28.65 billion in revenue. Market will be looking for a beat along with rosy guidance as well. And we can see a week out from their earnings report, Nvidia starting to look like the S&P 500, close to putting in a double top, bit of a bearish divergence, reversal signal, kind of done that hard, sharp bounce back off August 5th lows. But the higher we trade up going into earnings, the bigger and bigger the market's expectations it will be, and that's going to be a big event this time next week. Still at the back end of Q2 earnings season, a few more retailers this week. Target today had a pretty good rip. Once again, mixed signals from the economy and companies within it. Some are struggling, some are not. Target's revenue rose 2.7% year over year to $25.5 billion for the fiscal second quarter, coming in a bit ahead of expectations. Same store sales rose 2%. Guess if you adjust that for inflation, the real number's actually a little negative. Companies buying back shares, and they actually raised their full year earnings forecast. So higher than what the street was expecting as well. Hence why the algos are loving it today and repriced it much higher to start the day off. However, it finished on its lows, still 10% higher than yesterday, and this had been beaten down a bit over the last few months. On the other hand, we got Macy's, similar business, leveraged to US consumer discretionary spending. They got hammered in the market today. The same store sales declined for the 9th straight quarter, down 4%. That was worse than predicted, even though they beat on earnings. They lowered their revenue outlook, and they're still in the midst of a turnaround strategy, closing stores, trying to boost margins. However, that's still yet to be seen. There's the market's reaction today, down almost 13%, trading pretty heavy there. And just a look at the overall retail sector, XRT, pretty much been consolidating since March. We'll keep an eye on this for indications of the US consumer as well, with some of the most important being Amazon and Walmart, which actually just broke up to new all-time highs last week on the back of their earnings. So once again, a little mixed out there. Moving on to commodities. And just like the 10-year, we've got crude oil trading pretty heavy as well, most likely on demand worries. Big downward revision in the US jobs market likely didn't help things today. Could be getting a bit of cooling of geopolitics with the Israel-Hamas ceasefire deal. Iran looks to have backed down. Doesn't look like they're going to do that big-scale response. That seems likely. However, the big build-up of assets by the West and the region may have just deterred them. However, that's still yet to be known, but the market certainly isn't pricing in any action over there anytime soon. Still getting soft data coming out of China, along with the big increase in EVs around the world. And there's a look at crude right at the bottom of the support zone I've got in there, about 71.40 a barrel, and that could be broken through as well. Good sign for inflation, just not a good sign for economic demand. And so with a lot of financial markets pricing in a weaker US economy, the US dollar being one, a lot of large foreign investors pursuing de-dollarization, now got emerging market currencies breaking out. This is all a strong tailwind for gold and commodities in general. And there it is, just hovering around all-time highs, $25.50 an ounce. And what you're looking at here is a spread chart of the gold mining ETF GDX to the gold ETF GLD. And that's in a bit of an uptrend this year as well, close to breaking out to highs. And if I just zoom out to a monthly chart on this spread, starting to look pretty good to me here. We may be completing potential stage 1 accumulation and ready to go into a stage 2 advance, the sweet spot in markets where all the money's made. And miners have underperformed significantly for a long time. Look at that off the last commodity bull market peak back in 07. Miners are very volatile to the underlying, but gold could stay where it is right now, and miners could still have a lot of catching up to do. And I, for one, are going to keep my portfolio definitely exposed to miners, likely for years to come. And if the gold price keeps ripping up to new all-time highs, they won't be able to keep ignoring that. A lot of the companies have good balance sheets, pay dividend yields, and they'll be in a position to start buying back loads of stock, and they'll force the stock market algos to mark them up. Also, good news for gold bulls. Price of gold still hasn't even broken out to new inflation-adjusted highs, which reached 26.37 back in 1980. In fact, we haven't even taken out the highs from 2011. So gold, relative to the amount of US dollars out there, is still below all-time highs. And who knows, in this bull market, this chart could go up to $10,000. And believe it or not, there's actually been outflows of gold ETFs as a whole in this latest bull market over the last year or two. However, the market's starting to come back. We can see that in the amount of tons of gold held by GLD creeping up these last couple of months, just as we've seen the bond yields dive off along with the US dollar. Cool chart here on the supply and demand in the silver market. Just looking over the last 9 years, 2015 to 2024, total supply is down 4%. Mine production's actually lower as well. Got to remember, in the commodity markets, they'd been beaten down since 08, 2010. Huge underinvestment, multiple year lag on investment production for a lot of them. But we've seen demand in that time up 14%, with the biggest increase coming from electronics, thanks to the boom in the solar sector, which uses silver. Parts of the AI industry are using it as well. And like a lot of commodity markets, forecast to be a huge imbalance between demand and supply for years to come. It's a strong tailwind for prices as well, especially if stocks ever come off and investors start looking for what's working out there. That's how you get a pile on and a big fat bull market. Central banks around the world accumulating it at record pace. Also got the Chinese getting back to importing a lot of silver as well, really taking a liking to precious metals here. Another thing the Chinese are doing, becoming a lot more frugal, looking at a annual percentage change of China's fiscal expenditure, government spending, and a clear downtrend over the last decade. Pretty much the exact opposite to the US government, who are going in the opposite direction. And don't be fooled just because you're not hearing it in the headlines. Geopolitical tensions haven't gone away. In fact, Ukraine's getting a lot more aggressive, even just started targeting Moscow with one of the largest drone attacks ever inside Russian territory. The Russians just having to shoot them all down, 45 Ukrainian drones. This is on top of sending troops inside Russian territory as well. And it could be just Zelensky trying to cause a showdown before the US federal election. Maybe he's worried a change in the White House could potentially bring an end to the war. And so we should expect a continued and larger response from the Russians on this as well. And will be interesting to see how the US election plays a role in this war, along with what's going on in Israel as well. And just getting back to the charts, One thing that's not really bullish is the spread of high beta stocks versus low volatility. Just kind of sitting at their 50-day here, but could still be in a downtrend. Same with growth versus defensive sectors, discretionary versus staple stocks, and obviously copper versus gold is very weak. Inflation expectations still tracking down, and we do have some strength in these defensive sectors like utilities, staples trading up to a 52-week high today, and healthcare stocks sitting up there as well. And there's mega cap tech just kind of hanging around above its 50-day. So the market's really just waiting from Jay Powell. Confirmation he's going to cut next month, along with Nvidia earnings. Be the big one next week. But volatility markets are rather tame, along with high yield bonds. Really just got that weakness in the dollar and bond yields as well, along with crude oil. That's really what I'm watching this week. Other than that, tomorrow we'll get PMIs, weekly jobless claims as usual, and we'll just have to wait and see what Jay Powell says this Friday morning. I'll be interested to hear his reaction to the huge downward revision in the jobs market, along with his view on inflation and any indication of what sort of cut he's going to do next month. Other than that, the S&P 500 is pretty much sitting at all-time highs as we go into that. Thanks very much for sticking with Click Capital, and I'll see you guys again tomorrow night. Cheers.